What's the most important decision you will ever make as an investor? It's not which stock to pick. It's not about analyzing balance sheets, and it's definitely not about trying to time the market. The legendary investor Benjamin Graham, Warren Buffett's mentor, said that before you do anything else, you must answer one fundamental question. What kind of investor are you? And he didn't mean what you want to be, or what sounds impressive at a dinner party. He meant who you truly are emotionally, psychologically, and practically. Think about it. Most investors don't fail because they choose bad investments. They fail because they choose a strategy that doesn't match their own nature. It's like trying to run a marathon when you're built for sprinting. You'll just burn out. Graham understood human behavior better than almost anyone. He knew that the market doesn't defeat most people. People defeat themselves. Your investment strategy has to be three things: financially sound, emotionally sustainable, and realistic for your lifestyle. A brilliant, complex strategy that you abandon in a panic is far worse than a simple, steady strategy you can stick with for decades. This is why Graham divided all investors into two main categories: the defensive investor and the enterprising investor. It's crucial to understand that neither one is better than the other. But confusing the two, or trying to be a little bit of both, is incredibly dangerous. So let's find out which one you are. First, let's talk about the defensive investor. This is not the weak or lazy investor. This is the honest investor. This person understands that their time is limited, their energy is limited, and most importantly, their emotional tolerance for stress is limited. The defensive investor doesn't try to outsmart the market. They simply try to avoid being badly hurt by it. Their primary goal is simple: protect their capital from serious loss. Earn reasonable but not spectacular returns, and achieve freedom from the need to make constant, stressful decisions. This investor values peace of mind far more than the thrill of the chase. And Benjamin Graham believed this was the right path for the vast majority of people. So what does a defensive investor actually do? They invest regularly, like clockwork, not impulsively based on a hot tip. They diversify their investments broadly, so no single mistake can wipe them out. They avoid complex, trendy assets that everyone's talking about. And they accept that earning average market returns is actually a huge win. This investor isn't chasing the next big thing. They respect the market's power and unpredictability. Diversification is their shield. It's not about getting the highest possible returns. It's about minimizing regret. When you spread your investments, a single bad decision won't destroy your portfolio. The emotional pressure is lower, and your chances of long-term survival go way up. Graham's message was clear. Survival comes first, growth comes second. But let's clear up a huge misunderstanding. Defensive investing is not passive ignorance. It doesn't mean you blindly trust anyone's advice or just throw your money at something without looking. It means being selectively cautious. The defensive investor still demands that a company has financial stability, a reasonable valuation, and a proven business model. The difference is, they avoid the overconfidence of trying to find the one hidden gem that will make them rich overnight. Now, let's turn to the other type, the enterprising investor. This is probably the most misunderstood category in all of finance. The enterprising investor is not a speculator. They are not a gambler or a thrill seeker. The true enterprising investor is disciplined, patient, and deeply analytical. What is their goal? They are looking for specific opportunities where the market price of an asset is significantly different from its underlying value. They hunt for misunderstood or neglected companies. They aim for higher returns. But this is the most important part, they know these returns must be earned through real, substantial effort. Higher returns aren't a reward for being brave. They are a payment for doing hard work that others aren't willing to do. And Graham was extremely strict about what this extra effort means. To even think about being an enterprising investor, You must be willing to consistently read financial statements in detail, deeply understand business fundamentals across different industries, and most critically, remain completely rational when everyone else is panicking. You also have to accept that you will have long periods where your smart picks underperform the general market. If you are not willing to do this work week after week, year after year, then you should not pretend to be an enterprising investor. This leads to one of Graham's strongest warnings: the danger of being a half-enterprising investor. This is the person who takes on the extra risk of an enterprising strategy, but without doing the extra analysis and without having the extra discipline. They hear a good story, buy a risky stock, and hope for the best. This type of investor almost always performs worse than the simple defensive investor because they combine high risk with high ignorance. Boldness without preparation is just a fast track to losing money. So how do you know which one you are? The true test doesn't happen when the market is calm and climbing. It happens in a crisis. When prices are collapsing, when the news is relentlessly negative, and when everyone around you is selling in a panic. Ask yourself, honestly, in that moment, do you feel an overwhelming urge to do something? Anything? Do you lose sleep at night? Do you feel consumed by regret and fear? If the answer is yes, then a complex, active strategy will destroy you. Graham believed that this kind of emotional self-knowledge is infinitely more valuable than any amount of market knowledge. This brings us to a quiet but powerful lesson woven throughout his work. Average decisions repeated consistently will always outperform brilliant decisions made occasionally. The defensive investor wins by simply staying in the game. The enterprising investor wins by staying relentlessly rational. Both of them lose the moment their ego takes control. The final mistake people make is constantly switching between these two strategies. They act defensive after they've lost money, and they get greedy and enterprising after they've made some. This guarantees you will buy high and sell low. Graham's advice was to make this choice once. Consciously decide which type of investor you are based on your true personality and circumstances, and then commit to that path. So, the most important investment decision isn't about a stock. It's about you. Are you the steady, disciplined, defensive investor who values peace of mind? Or are you the analytical, hardworking, enterprising investor willing to put in the effort for higher returns? Be honest with yourself. Because choosing the right strategy for your personality is the foundation upon which all future success is built. Thanks for watching. If this helped you think more clearly about your own investment journey, consider subscribing for more insights. See you next time.